Welcome to Better Returns, where you will learn how to escape the volatility of the stock market by passively investing in real estate like a pro. 90% of millionaires earned and maintained their wealth by investing in real estate. We will share real-life examples from savvy investors so you can do the same. He is the only member of his immediate family that does not have any tattoos. Your host and my dad, Matt Hansen.
Welcome back to the show. It's my honor and privilege to have Mark Kenney on the show today. Mark is a seasoned real estate investor, coach, two-time best-selling author, and the co-founder of Think Multifamily, which is an elite apartment investing group that he runs with his fabulous wife, Tamil. Actually, full disclosure, I'm a member of that group as well. Mark started his apartment investing career over 25 years ago as a side hustle while working 80 hours per week in the corporate world. He's purchased over 16,000 units, over $1 billion worth of assets across 13 states. And he's one of the most respected authorities of acquiring and managing multifamily assets in the biz. So, Mark, again, a pleasure to have you on the show. We're going to talk a little bit about what it takes to be a good general sponsor to a deal and how the expectations of the passive investors, what they should be looking for in a great deal sponsor, because you have done over 100 deals, hundreds and hundreds, thousands of probably investors that you've helped move their money from Wall Street to Main Street, passively investing in apartments. So tell us a little bit about, I guess, first, how did you get into this from, I think your training was a CPA. How did you get into multifamily to begin?
Yeah, thanks for having me, Matt. Always a pleasure to speak to you. Yes, so I was going to college for accounting. I have an identical twin brother, and we didn't grow up with a lot. I mean, most, food, place to live, which is more than a lot of people, but anything extra we were buying ourselves. And I'm like, this kind of stinks. So for some reason, we didn't have anyone in our family or relatives or anyone like that doing real estate. But my brother and I were like, people need a place to live. Why don't we try to buy some real estate? So seniors in college, we decided to go look at smaller properties, 2 to 4 units. We bought a property when we were 22, 21, 22, you don't remember exactly, and rehabbed it kind of ourselves. And we both graduated in accounting. I was, like you mentioned, a CPA for a while. Then I did business manager consulting at the Big Four, IT consulting, continued to buy smaller properties. I started an IT firm in 2008, and I was doing pretty well. At least I thought I was doing pretty well, at least financially. But my wife, when I say 80 hours a week, she's like, no, that's low. You used to work way more than that. 90, 100 hours a week, consistently for years, though, not just like once in a while. And it caused some issues because I was 24 hours a day. I would sleep like 3 hours a night. And my wife and I were buying small properties. And she's like, this is, your schedule is like, it's not working. You need to do something different. And I'm like, okay, in my spare time, okay, let's figure this out, But I said, okay. I mean, it was kind of more an ultimatum, And so got a little serious. And I said, well, we're going to have to do it together because you're going to have to help me. We both loved real estate for whatever reason, just had a passion for it. And so I invested passively first in a syndication in 2013. Didn't know what syndication even was until that time. Had a friend that was doing it, used retirement funds. But basically that kickstarted kind of the light bulb and say, okay, well, I think we can do this too. We're already buying small properties. And then we looked at doing syndication ourselves. And, it took us about a year to find our first property. We were looking at a lot of other things to get me out of my IT business, essentially. But we ultimately ended up with multifamily, which I'm very excited and happy that we did. And then we just kind of went off the races and purchased a number of larger properties.
So what was your first deal? What did that look like? Your first syndication deal? So you got rid of the single family stuff and you transitioned to multifamily. What did that first deal look like?
Yeah, for one, when you're looking at becoming a syndicator, you want to build relationships with brokers. So there was a deal that was a 32-unit deal. I had very little interest in it because it was really too small. I didn't want anything that small. Mm-hmm. But I wanted to build a relationship with a broker here in Dallas. First time meeting him. And then when I was touring the property, he mentioned, well, the seller has another 32 units right there, like it was 200 feet away. And he might be interested in selling that. Well, lo and behold, we ended up getting both properties, and it was still a little bit smaller. We were looking for a 100+ unit. We wanted to go, I'm kind of glad we probably started with a 64 because the raise, I was really petrified to be trying to bring capital to a deal. It was $1 million raise. at the time, never had, even tried to raise capital. I mean, was IT guy, CPA background, but we ended up getting that one, our first syndication, and it was here in Dallas. And again, it was about $1 million raise on that one.
Wow. In a great market. You just happen to live in a great market to do that locally, which is good. So a lot of people try to do that remotely. Like I live in Michigan. For a while, I was
Right.
driving down to Indiana, Ohio, trying to find deals there. But it's like a 6-hour drive. You can't really fly
Right.
there.
It's
So it's
very
great you
time
had,
consuming.
yeah, and you were in right there in a great market. So that's a huge advantage. So
It was.
yeah. So what's your criteria? Well, I guess what's your criteria now for properties that, because you really cater to your investors. You're so investor focused. I know you really do a great job of communicating and educating. So what do your investors look for in properties? What's the criteria that they're gravitating towards right now?
Yeah, I would say it's going to vary a little bit on the investor. If somebody is a pretty seasoned investor, meaning they've invested in a number of deals, been investing for years, and like myself included, because I'll tell you kind of how I've changed a little bit too for myself. I'm more like, hey, let's have properties, all things being equal, less headaches, less potential risk, more knowns, and rather than unknowns. I'll give you some examples of that. And even though the returns could be a little bit lower, we were buying before some properties that are 0% occupied and 28% occupied. And there are a lot of issues with that. We've had properties where we've, returned 100% of the money and over 100% return in 14 or 15 months on those type of deals. You can't do that typically on a real, stabilized deal.
Right.
But a lot of people I think are kind of learning, hey, if I'm going to do a big distressed deal, you can pick your number. Maybe 1 in 5 you're going to do that way. But I personally wouldn't do all that unless you're a contractor full time and things like that. Just too much time, effort, too many issues with your loan, trying to get reimbursed. So a lot of investors are like, well, the nicer properties on a cap rate perspective, which just means how the property is valued. The spread between like a really nice property and a property that could be considered older, maybe not as nice, isn't that big anymore. So I do like newer is relative. We bought a lot of 60s and 70s properties. We bought 1945 property. But the 80s, 90s plus properties, just generally speaking, have less issues, just even from a physical perspective. They usually have all separate HVAC units where we own, a few properties that have a chiller, which means one machine basically heats and cools everything. If it goes down, which it's gone down before in the middle of, summer in Dallas, there's a big issue there, right? So, and then just physically the way they look, and then clientele wise, people argue, well, they're better tenants in an A versus B and C. I guess I wouldn't probably really totally subscribe to that, because there are certain markets we buy in that are a lot of C properties, but the people grow up there, they live there, they never move. It's not very transient there. So the bad debt in some cases is really, really low. I mean, we've had, I think, 14, 15 months in a row on the C property where there was no bad debt, which is pretty much unheard of.
Wow.
So very few Class A's probably can say that. But I do like properties that are, all things being equal, a little bit nicer, newer, and then market wise, we've bought in a lot of markets, a lot of tertiary markets, a lot of markets probably inferior to the primary markets. I think we still like those markets, provided we have a kind of long-standing history there. So if we've bought there before, we've exited there and performed really well, I'm still good there. Going to a brand new tertiary market for myself right now, I don't like doing that. There are a little bit more risk, in my opinion, in those markets. And if we don't have a history there, I'd rather go to market that either we already have the history there, so a little, same management company, same GP team, same kind of MO, less risk, generally speaking. I prefer that better than some of these other choices. And then you can't just go to every primary market and start buying Class A unless you accept your return is going to be quite a bit lower, which it will be. That's okay. So it's kind of a mixture of certain things. Some people are like, hey, I want to be able to go and, double my money in 2-3 years. That's getting very difficult to do. And I don't want to say impossible, but very, very difficult to do on a property already stabilized. You're going to be forced to most likely buy a distressed property and contend with all the issues potentially there.
Right. And then that's the beauty of the Think Multifamily group, is you kind of alluded to this, is like once we get into a market, because the reputation is so good that you and Tamil have created, is that like Decatur, Georgia is, I think, the city that, a suburb of Atlanta, that how many properties does our group have there? Six, eight?
A number. And then we bought like in Dalton, Georgia, which I never heard of until 2018, just through some circumstances. My twin brother lives in Atlanta area too, but we've bought and exited 3 properties there. The returns have been like, I mean, insane. We have another 2 properties right there under contract, but it was just through some circumstances,
Mhm.
right time, right place. We bought in places like Memphis starting 6 years ago. Done really, really well there.
Mhm.
Personally, I wouldn't go there right now. It's my personal opinion. When we're buying stuff for 25, $30,000 a door and selling it for, 80, 85,000. Yep, I'm pretty happy with those, but I'm not comfortable going to a Memphis and paying. We have some properties there over $100,000 a door, right? And I'm like, nah, there's other markets I'd rather be in. Now, there are other reasons you might go there because of their tax incentives and things like that. But we learned a lot how things reacted during COVID, what landlord friendly really means. Because and when you say state's landlord friendly, lots of times it's not. It's county by county. So it depends on the judge in that
Right.
county. So we ran across that. If we buy a property, which we bought a couple right before COVID hit, like a couple months, and then the business plan only worked if we retenanted the property and do a major capex. Well, when COVID hit, we couldn't do either of those things.
Mhm.
So I'm more of the opinion, let's find properties that will perform regardless. Maybe it wouldn't perform quite as well if you can't totally meet your business plan, but you don't run that risk of, oh my goodness, we can't even, retenant the property because we can't evict and we can't do capex because nobody wants to work and can't, all those things like that. Or properties where we actually did go in and do a lot of capex, and we've had, if it's almost vacant, 0%, one building we had. Well, then we do it, and then people, vandals come in and destroy the property in hundreds of thousands of dollars of damage, and then you're paying $200,000 a year to have a security guard. So again, not saying anything wrong with all those things. I mean, if you look at the ones we've done like that and the returns, I mean, they're on average phenomenal, but more risk, bigger headaches. You're dealing with lenders that are slow to reimburse you. You're paying vendors hundreds of thousands of dollars, waiting in some cases months to get reimbursed by lenders. So for me, I've made a shift more. I'm not doing any distressed properties anymore. I'll coach people on it. I think I have a lot of experience with it. Fortunately, unfortunately, I'm not sure which, but I'll definitely coach on it, but I'm not buying them anymore.
Right. Right. And that's the great thing of the experiences you have in the markets you've, played in the cycles you've been through. You continue to, modify or pivot, if you will. Okay, this is the market I want to be in. These are the type of
Right.
properties we want to go for. Like you said, I know years ago there's one big, huge distressed property. It was like 400 some units that we took over. The group did. And I know you were lead with one of the other individuals. Like, wow, my eyes popped when I heard it. And it did extremely well. But that's a
Yeah.
whole different beast than a typical light value add where you're putting, 5 or 6,000 per unit in
Right.
renovation versus, oh,
Right.
it's 40% occupied and a whole bunch of units are burnt out and all that. So I love the
Right.
fact that we've kind of specialized. I think multifamily deals are typically um, class B, C plus, nice population and employment growth areas,
Right.
mostly south, southeast. We're getting into Arizona now, right? We're in
Right.
Arizona.
That's right. I mean, the Sun
We're,
Belt, like you're mentioning right now, the Sun Belt is, the top 10 markets
yeah,
through September has been in the Sun Belt, right? So we southeast in Texas are where we're at. And, I wouldn't say, hey, just because like when we exited a bunch of properties at the top of the market, last year,
hmm,
people look and they go, oh, look how smart I am. I'm a genius, stuff like that. No, I think you probably got lucky, just like we got lucky. We happened to time it at the right time. But to sit here and to say, oh, the property's gone up because, yeah, you can contribute to that, but you have to get some credit to the market. You
right.
do. And it's some cases there's a little bit of luck involved on it.
And it's calculated luck. I mean, it at your
Well, you're
level.
looking at
Yeah,
things
yeah,
to
yeah,
say we're
yeah.
looking at it saying, can we hit some of these cases properties we've owned for 2 years or less, we're hitting our 5, 6 year projections, right? So now, so we'd say, well, it makes sense in my opinion to sell. So, the people that sit there and then, I have another partner that doesn't want to sell anything ever, right? from back in the day, and doesn't matter how good the returns are going to look. And I don't think that's, as a syndicator, I don't think that's fair. I don't. I think you owe it to your investors to have either a major capital event through a refi or a supplemental loan and continue to cash flow. If you can't do those things, I think you owe it to your investors to sell.
Yeah. After all, you met the business plan. We kind of got a fiduciary responsibility to say, okay, the velocity of money comes in. Now we've accomplished what we wanted to do. We did it in half the time. Well, let's
Right.
give your money back. And now you can do something else with it, with all your
Right.
gains. Because
Right.
I
But as a
love that
syndicator,
approach. Yeah.
that's right. So if you and I are both general partners on a deal and you want to sell and I don't, we have an issue. So you need to make sure your docs support the ability to have some sort of tiebreaker, which I didn't have back in, when I started doing this originally. So literally prevented from selling without both of us agreeing to it. So big lesson learned there. It's painful.
Excellent. Yeah. So there's triggers in there. Yeah, you've accommodated for it now that you know this could happen. Like,
Right.
how do you address it in
Right.
a fair and equitable way, particularly to the investors?
Sure.
Got it. Oh, that's interesting. So let's talk a little bit about how does somebody overcome? I know this has been 6 or 7 years when I did my first passive investing. I wired that first $100,000. What do you do? Because you work with lots of investors. What do you do to help them get over the apprehension of, okay, I'm sending this money to Mark, or to it's actually to the LLC of the apartment complex. What are the
Right.
typical concerns that you usually hear from new investors that you kind of, hey, I'll explain this to you, and this is the reason why, or these are the challenges that they have, because it's really a mindset thing. If you've only invested in Wall Street, now there's an opportunity to invest in apartments. This is all new and
Right.
foreign. So how do you get over that learning curve for your new investors?
Well, some of the benefits to it that doesn't really exist typically in Wall Street would be you have direct access to the sponsor, right? The general partner. So if I invest in Coke, I don't think the CEO is going to take a call from me, right? They're not. So you have direct access there. And then you have the ability to, go touch the property, see it, feel it. You have tax benefits that generally speaking don't exist in the, regular Wall Street. They just don't. Now it's different for every person, but you will get tax benefits allocated to you depending on your timing when you can use it and things like that. And then, as far as the market for multifamily, it performed really well during good times. It performed really well during COVID. There was some rent relief that helped there. It did. And it's basically, as much of an inflationary hedge as almost any investment period out there, continues to perform well. We're still increasing rents. Renewal rates are up across the entire country by $125 a month, which is about $30,000 of value per unit without going into all the math. So renewal rates, I think about 60%. So there are a lot of good things going for it. Now, am I happy the interest rates are through the roof and Fed, keeps no, I'm not. All things being equal, I'd rather they weren't doing that. So people ask, well, hey, is now still a good time to invest? Well, there are a lot of good stats if you look at it. Would say yes, single family homes are being priced out for many, many people. So more people are renting. We're pushing rents on, every 4 to 6 weeks, but we're pushing rents, on our properties, and we're getting it. So yeah, I think it's still now to sit on the sidelines. People go, oh, I'll sit on the sidelines and do nothing. Well, that doesn't make sense to me as a syndicator or as an investor. Now, as a syndicator, you always need to be looking. Maybe you don't find anything because nothing, you just can't find it, but you need to underwrite with, the current terms of the market and things like that. As an investor, if you say, well, I'm going to sit on the sidelines, well, okay, but, in the market, God really knows what's going to happen in the market, right? With a roller coaster and things like that. You don't make money or lose it unless you sell either. The bank is pretty much, it's going to take you 1,000+ years to double your money in the bank if you want to double your money. So, I mean, and with inflation, that's not even including inflation, by the way. So, what do you do? Now, with all that said, and I generally mean this, is that in some cases, not everything is a financial decision. If you're going to invest in anything, I don't care if it's a market or in multifamily, and you're going to be so petrified and so nervous and scared and sick to your stomach, then don't do it. Accept the fact that you're going to lose money by having the bank, and I really mean that, and be okay with it. That might be okay because of the stress related to it. The best way, though, for people to really figure out, hey, should I be investing or not is, okay, how do I know that a deal is good? Well, reality is you don't. Nobody knows, right? We're using data that it's going to be
Right.
good, right? We're using data to project to say, okay, here's the data we have based on our experiences, based on third-party input from management companies and tax consultants and all these things. This is what we believe is going to happen on a pro forma, right? So as an investor, I have a guy that I spoke with last week. He's gone into, I think he said 8 syndications like in 6 weeks, no joke. Um, and he's like, I don't even feel like I'm probably really that qualified, as far as like to know whether a deal looks good on paper or not. Well, there are certain things you can learn pretty quickly as even a passive investor. You don't have to be in Excel every day and do what we do on a daily basis. You don't have to do all that. But there's certain things you can look at or questions you can ask to say, okay, based on these questions and input I'm getting, does it look like this deal is legit? Looks like it's potentially doable. And people say, what's the worst case scenario? Worst case scenario, you lose all your money. People are like, oh, I think, no, that's your worst case scenario. What's your worst case scenario in the stock market? You lose all your money. Now,
Right.
does it typically happen in real estate? No, but you need to go and do an investment, realizing that it's an investment, there's risk involved in it. So get educated as much as possible to feel comfortable one way or the other to invest in the deal or not.
Absolutely, absolutely. The beauty thing about, from a risk adjusted standpoint, real estate's still one of the best investments because it's
Right.
collateralized by real estate. It's a physical asset and it's not a paper stock, so there is some
Right.
advantages, but you're right. It's like any other investment. Catastrophic things can happen. The world can change. You never really know.
Well, yeah, and you look at it from the standpoint, who are the largest investors in real estate? It's actually the lender, right? They're
Oh
putting
yeah,
the
yeah.
most in. So if you look at it and say, how do lenders look at multifamily real estate versus things that aren't real estate and even things that are real estate? How do they look at it? Well, if I'm buying larger multifamily, which I have like no joke, $800 million in non-recourse loans, well, the lenders look at it differently, right? Single family home, 1 to 4 units, you're going to have recourse, personal liability. They look at it differently. We're getting higher leverage than we would off an industrial building, or higher leverage than we would off of self storage. So how do I'll tell you that probably the two people in the world that never lose industry wise, insurance companies and lenders. They just never lose.
Yeah.
They don't. So look at what they're doing, where they're putting the money. They have risk tolerance levels associated with every investment. And we're going to get the highest, generally speaking, the highest leverage, the best terms, non-recourse debt without personal liability and things like that on multifamily than virtually any other investment, period.
That's a great sign. That's an indicator.
Right.
The people that are making all the money, the profit margins are phenomenal for banking and insurance,
Right.
really. That
Right.
yeah, if they're putting their money here, well, that's probably a good place for as an investor to put your money because they're usually 75% or 70% of the equity of an apartment is the lender.
Right.
And then the other percentage is the capital raising from investors like you and I and our friends
For
and
sure.
family that invest with us. Good point. That's a really good point. I never thought of it that way. It's absolutely true. That's where they're putting their money. And
Right.
yeah, that's a good move. So what should a person look for if you're new to it? What's a good person you should invest in? Like you said, you want to trust somebody that knows the market, knows what's going on. So what are your expectations? And I know you treat your investors really well, but what are the expectations that you make sure you fulfill for all of your passive investors? What are the things you do for them?
Yeah. I mean, it's a small world, right? And I think that the whole idea around having the communication, the open communication, responsiveness. I mean, don't get me wrong. There are some investors that are pains. They really are. I'm not just saying it to say it, that overly for no reason, right? Just because
Right.
that's the way they are. But that's very rare. It really is. So I have found that as long as you communicate with an investor saying that, hey, I'm not sure, I'll get back to you. The worst thing you can do is ignore an investor, right? Just like I never respond. And it's happened before with asset managers, and we've taken corrective actions. You can't do that, right? You have to respond. The response could be, I'm not sure, I need to get back to you, but it's much better than not responding at all.
Right.
So response time for sure. Making sure that you're providing monthly reporting. Some people do quarterly. I don't know. That seems like a long time to me.
Yeah.
But providing the, profit and loss, which is the T12, the rent roll, balance sheet, general ledger, all those type of things. So that full visibility, here are all the books, right? There are a number of things out of our control, unfortunately. This year was horrendous for K1s as an example. So, investors get frustrated. I get frustrated too. But I would say if you're coming in, potentially investing as a multifamily investor, I would assume you're going to do an extension. If you can't, like, if you want to say come to terms or accept that, I probably recommend you don't invest. Now, a lot of other years really weren't that many issues. This year was horrible. I mean, just not just for us, across the whole entire country, right? So those are things too, right? You have to accept that, hey, I'm going to come in, probably going to have to do an extension. No, I don't want to do one. Okay, then don't invest. So and then I think one of the big things is really, and then you talk to people that I've spoken to, investors, is trying to put myself in their shoes. I really do, and say, okay, here's different deals we have going on. Here's what, if I was in your shoes, here's what I would do. I would split your money up. Don't put, if you have $500,000 to invest, I wouldn't put 500,000 in a single deal, the general statement, because something could happen, right? But put myself in their shoes and say, okay. And then also, as a general partner, if you, let's say you're putting a deal together and I say, hey, Matt, what do you, like about the deal? You tell me, and I ask you, what don't you like about the deal? And you're like, nothing, actually, everything about the deal I love. No, it's probably not true. There's probably, I mean, I can't think of a single deal out of 100 plus deals done where there isn't something.
There's one thing that's not quite
it could
right.
Be
yes.
something that's like, but it's not enough to like not move forward, right? So if a syndicator is like, well, everything's great, hunky dory, I probably wouldn't invest. And then a couple other things, it's not really geared towards what we do, but just the general statement, you need to make sure that the person running the project, if they have a full-time job somewhere else, they need to have I'm more of an opinion that the asset managers need to be full-time. I'm not saying you can't get away without doing that. If you have one or two properties, you can probably. But we've done it before. People have W-2 jobs, running deals, things like that. Just harder to do that. So having dedicated asset management team is always good to have. Some properties, if you had 10 properties you're asset managing, you're going to have one that takes 80% of your time. You just have that one property, just reality. So, and then just the track record, right? I mean, for me, we can go through kind of, and be totally transparent, where have you had struggles? I mean, I can't tell you how many times I hear, see all this stuff posted and these groups and things out there, and like nothing ever goes wrong. And I know firsthand, like inside information, and they don't share any of it. You're doing a disservice, in my opinion, to syndicators and also investors without sharing that. I've shared on different podcasts one horror story that I've had. I mean, thankfully it was only one, like to that level. But I know for a fact the lessons learned from that story and that real example have helped a number of people not make the same mistakes I made on that deal. So even from a legal structure, that was one of the biggest things we did differently than any other time, and it caused us issues. So be transparent, own up to things. No one's ever going to be perfect. Be responsive, and just try to always put yourself in their shoes and be sympathetic to them, and do what you can. There's so many easy things you can do, and there are hard things that just are hard, right? So the easy things always do well. They're easy, right? And then the things that are out of your control, like K1s, you can push and push and push. And I know investors get frustrated with it, and we get frustrated too. But the reality is that we have very little control how fast some of those things will get done. So, and we've learned more and more, right? If you do more and more deals, you learn every single deal. And then you can convey that to other people and say, here's what we've done. We tried this. We tried using, a property management company and in-house on the same unit to fix things. Doesn't work typically. You need one neck to choke. I mean, just things, you can convey to people, say, here's what we've tried, didn't work, so we don't do it anymore. But the biggest thing for me, I think it really is, it's the communication, being at least responsive to people.
Right. Those are some great tips for new investors. Everything Mark says is what you should expect from your general partner. Transparency, clearly telling you what the issues are, because there's always something. We've done lots of deals, and there's always one or two things that are not quite right about the property. It's better to disclose that now than them discover it later. And it
Right.
gives you more credibility because there's no deal that's perfect. They don't
There's
exist.
not. There's
That's
not.
the thing. So somebody's
Right.
telling you there is, they're
Yeah.
hiding
I wouldn't
something.
invest. I wouldn't
Exactly.
invest.
Excellent advice. Thanks so much. And I've learned so much from you, Mark, and that's how I treat my investors based on, very strong ethics. I mean, that's something I really enjoy about the group that think multifamily is like, there's just no gray area at all. You do the right thing for your investors, your business partners, your service
Right.
providers. It's really, you have high standards and I really appreciate that. And it's not right for everyone. Not everybody can live to those standards, but
Right.
you set those and we all comply with it or we don't stay. So, and that's what I love about
Yeah,
what
that's
you
right.
do. Yeah, that's wonderful. Well, now it's time to get to know Mark a little bit more on a personal level, the rapid fire 5. Are you ready, Mark?
I don't know what's coming, so I'll let you know.
Okay. The first one, what was your nickname as a child?
Uh, my brother Eminem, is an identical twin
Oh,
brother. We were called the Bopper brothers. We used to fight a lot. So yeah.
Mike and Mark. Yeah, Eminem.
Yes.
That's pretty good. Yes. Are you a morning person or a night owl?
Morning.
But yet you reply 24/7 pretty much to me and text. This guy's incredible. No matter when I text you, it doesn't matter. You're just boom. Again, you're so accessible. So I'm surprised morning, but you don't sleep often. What would be the first thing you did if you won the lottery?
Buy a Koenigsegg car
Very nice. And I want to ride one too when you get it.
for sure.
If you could live anywhere in the world, where would it be?
Wow, that's a good question. Probably California without the politics and taxes. So if I could change that, that's probably where I would live.
Where in California?
Southern for sure.
San Diego?
Yeah, warm, warm. Yeah.
San Diego's my favorite. And then finally, what one piece of advice would you give to a new investor to help them get better returns? The one key piece of advice.
Educate yourself and then talk to other investors that have been investing longer than you and ask them their input and what they would have done differently and what they learned through the deals that they've actually invested in.
That's really good. People don't think about check references and ask somebody that's been doing it for a while and say, well, what are the things you have to look up? That's really good. I haven't heard that one. Excellent. Thanks so much for your time, Mark. How can people get a hold of you?
Best just email. It's Mark, M-A-R-K at thinkmultifamily.com.
And I'm just going to give a personal plug. Think Multifamily. If you want to be a syndicator or general partner, there is no better group in the world than Mark and Kenney's Think Multifamily. I'm putting the plug right out there. It's phenomenal. It's a very cohesive group. Everybody shares information. There's not a whole bunch of intercompetition. It's everybody raising everyone else. And that's just really rare in the world today. So I thank you for putting that group together. And I'm glad I'm a member. Thanks so much, Mark.
No, me too. Glad you're in.
All righty. Have a great day.
You too, Matt. Take care.
And that's a wrap. Thank you for listening to Better Returns, brought to you by Hanson Holdings. If you enjoyed this episode, please leave a 5-star review because it helps others discover this valuable content. If you would like to earn truly hands-off passive income, go to hansonholdings.com, where we help you invest in large apartment complexes to grow your family's wealth. See you next week with another awesome episode. Have a great day.